Well, hello friends, Mark Martella here for Money Matters, where I help you break your addiction to credit and bring some sanity to your finances. Well, again, if this is your first time here watching this show, I have a website. It's simply markmartella.com. You can go there and get answers to your questions. We have a whole bunch of videos, all the past live shows. We have our 2-minute tips. We have a free resources page where you can find things like my ultimate budget planning tool, get a free copy of my book, Bankruptcy in Plain English. So I'd encourage you to go there. Again, it's www.markmartella.com. Hi, Elise. If you have a question you'd like answered, just put it up here on the message board and we'll try to get to it. I'm a little technically challenged sometimes with this, but we'll do our best to answer all of your questions as they come up. So today what I'd like to start off with, I know we're going to talk about HELOC loans and some of the big mistakes that I see people making, but first I always like to start with a rant. And my rant today, and again I'm amazed at the things that I see as I further investigate these things and financial situations out there and mistakes that people make. So I'm sure you've seen these commercials for these companies that will give you a lump sum payment if you have a structured settlement where you're getting paid X number of dollars over the years. So I decided to check one out and to see really what the costs are. And without actually applying, you don't know what the fees are, but they have some interesting videos to talk about, how an example of how things are set up. And the one example they have is, hey, somebody wants to buy a house and they need a $5,000 down payment, and they have a $20,000 structured settlement where they're getting $20,000 a year over 10 years. And instead of waiting for that, they can go to J.G. Wentworth and get half of that. Or get $5,000 of it. I'm sorry, it was at $20,000. So $2,000 a year over 10 years for a total of $20,000. But this person, in their example, they needed $5,000 right away. And so the $5,000 that they needed, they would have to actually assign $10,000 to J.G. Wentworth. And instead of getting a lump sum of $10,000, in the example that J.G. Wentworth provided, they would get $6,144. So therefore, right up front, J.G. Wentworth was getting $3,855. And again, this is their video. So in order to get $6,000, it's going to cost you almost $4,000. Now, instead, they could have just waited, or they could borrow it from a friend for they could try borrowing it. It would not be that crazy amount. And they talk about the discount rate, and the reason why it's costing this much money is because $1,000 today is not going to be what it's worth in 10 years, and they use a discount rate of 10% in their example. The discount rate hasn't been 10% since, I don't think, the 80s. If you look historically over the last 10 years, it's been anywhere from 0 to maybe 3%, usually around the 2% range. So the examples they give are really totally out of whack, but it's part of the game. And one of the games they play is this concept of anchoring. So if they're using this 10% number, and when they actually do a deal, it's only 6%, you think like you're getting this great deal, because in the example on the website, it was 10%. The other thing they're doing is they're doing the marshmallow test. You ever hear about the marshmallow test? It's a study that was done almost 50 years ago, where they tested some kids, and they would say to them, they put a marshmallow in front of them and say, if you don't touch that marshmallow, we're going to leave the room. If you don't touch that marshmallow, when we come back, maybe 15, 20 minutes, you're going to get 2 marshmallows. Well, a large portion of the kids couldn't wait that 10 minutes or 15 minutes, and they would eat the one marshmallow. And they follow these kids, and this lack of self-control showed later in life, where they were, who had better control of their finances and their retirement, and who succeeded better by being able to put things off. Well, that's the same thing, the same psychology they're using now. Why wait? Why put things off? Use your money now at a very, very high expense so you can get that benefit now. So again, there's other ways to borrow, especially when it's those smaller amounts of money, to give up $10,000 to pay $3,800 to get $6,200 is insane. And keep in mind, they're getting all basically their interest up front, plus after about 6 years, they're paid in full. In the last 10 years, that's all extra gravy as well. So please, if you have a structured settlement, you need money, don't use those. Unless you need to get money to save your kid to have surgery or something, don't touch that. So now let's talk about HELOC loans and what you really need to know, and some of the mistakes that I see people make are just due to lack of understanding. So the first one is just a basic lack of understanding as far as what a HELOC loan is. Again, it's a home equity line of credit. And I have so many clients focus on the concept of line of credit. Hi there, Dennis. And so they'll meet with me, and whether it's in a foreclosure context, a bankruptcy context, I'll say, well, you have this second mortgage, it's secured by your house. Oh, no, it's not, it's just a line of credit. I said, no, I'm pretty sure that it's secured by your house. No, they told me it's just a line of credit. And of course, we look it up, and there's a lien on their house. And people don't understand that when they take out this money and give a lien on their house, they can lose their house if they don't make their payments. And one of the big mistakes, and if you watched the show before, you hear me talk about it so often, a big mistake is taking out a home equity line of credit to pay off credit cards, because you're taking an unsecured debt and turning it into a secured debt, so that if you don't make those payments, although they may be lower than what you were paying for your credit cards, if you can't make those payments, you face foreclosure and you face losing your home. Hi, Della. So never take out money to pay off your credit cards and then secure it with your home. The same is true for a car loan. People think, well, it's a lower interest rate, but if you're taking out a home equity line of credit to pay off something over 20 years, even though the payment is lower, you're paying a heck of a lot more interest. And again, now you're exposing your house to foreclosure if you don't make those payments. Whereas if it was just a car, all they could do is take the car, maybe pursue you for deficiency. But again, it's not attached to your house. So again, read the documents carefully. Make sure you understand that this line of credit is secured by your house. And I think sometimes how people misunderstand that this is a line of credit is because the HELOC documents look different than a regular mortgage when maybe you bought the house. There's a 28-page document that you may have signed, but a HELOC loan, I've seen them as short as 3 and 4 pages, and they kind of incorporate the note and mortgage almost in one document, it looks like. There's some brief disclosure up top about the truth in lending, the interest, and everything you're going to pay, but that seems to mislead people as far as what this is. The other big problem I see with these HELOC loans is so many of them are interest only, and maybe interest only for 10 years. So if someone's paying $220 a month, it's no problem, but that 10 years go up or 15 years end. We're seeing that a lot now because of the loans that were taken out in 2007, 2008. That payment goes from $200 a month to $800 a month. And they were just squeezing by, being able to pay their first mortgage, taxes, insurance, and the second. So when it goes up that much, now they're looking at losing their home again. So you need to understand that. You need to understand what's going to happen in the future. Again, if you took out that loan back in 2008, they told you that you'll be able to refinance down the road, and then all of a sudden you're upside down in the house and nobody's going to refinance you. Hey, Todd, yeah, you're right. a lot of times there were no interest rate caps. So you have an adjustable rate mortgage that's going to adjust every year over 5 years, and you know, you started off at 4%. It could have gone up to 12%. We're not seeing them right now. Interest rates are still low, so you've been lucky that we haven't seen those high interest rates, but we're coming to a different time in the economy. And things may change. So if you're taking out that home equity line now and there's no cap and you've got to have an adjustable rate mortgage, who knows where we'll be 5 years from now. So again, things you need to be aware of. And then, you know, the idea is, well, first of all, never take out a home equity line of credit if it's for a vacation or some sort of disposable thing. Again, Todd, who is a commercial loan officer, telling us, you know, the rates are going up to 5 soon. And I saw a lot of rates just before I came on. I was looking at that 4.5 to 5 for a first mortgage. And again, usually your interest rate is higher for a second. So thanks for that information, Todd. But you know, the idea is, hey, you know, you get a call, hey, you want to redo your kitchen, you want to redo your bath, and you take out, say, a loan for $25,000 to redo your kitchen. Say, well, I'm increasing the value of my house. Well, if you're using, say, $5,000 of that for appliances, and you're taking out a 20-year mortgage, well, those appliances aren't going to last for the 20 years. So within that 20-year period, you're going to have to replace those. But, and again, I did my calculations based upon 4.5% to be conservative. But if we take out a $25,000 loan at 4.5% interest over 20 years, you're going to pay $37,958, almost $38,000 in interest or total in payments, including the interest. So you got over $13,000 of interest that's going to get added on. Again, like I said, your house, if you put $25,000 into it, it's not going to automatically appreciate to that. And again, right now, are we at the top of the market? How much more appreciation are we going to see? Are we going to see a little depreciation over the next couple of years? Again, I've been saying, I've written an article, we are close to the top of the market. Maybe we have another 12 or 18 months of growth, but this is a time to start getting ready. We can't control what's going to happen out there in the world. We can't control what the president's going to do, what Congress is going to do, what's going to happen in Europe, but we can control our own personal finances and stay within our means and be reasonable and take control. So I just know that I've been getting so many phone calls and letters on my phone about taking out the equity in my house. I'm seeing the signs on all the bank marquees as I drive around town about taking out home equity to, you know, to make improvements to your house. Really, if your house is, you know, your biggest investment and your goal is to make that part of your retirement, if that is part of your retirement planning, you should not touch the equity in the house. You want to leave it there, preserve it, enjoy the appreciation for when you retire. Again, don't be one of those kids who couldn't control themselves and take that marshmallows before they can get two. It's the same type of thing. If you're taking that equity out of the house now to go on a vacation, or, you know, worst case scenario I see so often is buying an RV, where you have the lien on your house and the RV is free and clear, and that RV, those things depreciate like a rocket going down. Ask anybody who was a former RV owner. I see people taking out their equity to do that, and they're going to live their dream, travel the country, and 6 months into it, something happens to one of them, or they realize they don't like traveling or staying in parks, and now they have this big thing that they're never going to make their money back on. So again, certain cases, you know, we have a hurricane and you need a new roof, and you have that deductible, that hurricane deductible, and you're short $10,000, well, that's a good reason. You need to preserve the house. You need to keep the water out of it. That's a good reason. When you do that, you want to pay it off as soon as possible, but that would be a good reason to take out a home equity loan. Making improvements to the house that you don't really need, that, in other words, that maybe you can save for, plan for, put it into your budget, know exactly what you want to do. You don't have to get the top level granite tops and cabinets and those type of things. You don't have to pay $10,000 for blinds. See what you want, improve it, do what's necessary, do what you like, but be reasonable. And figure out, have a plan. If it's going to cost you $10,000, how do we save that $10,000 over a year, 18 months? It's much better to pay that off than creating that line of credit. And then my final point about HELOCs are where it's truly a line of credit, where they'll say to you, and I saw this happen so often in the downturn, where people all of a sudden had $100,000 of equity in it, and they were just given a line of credit of $100,000. Why? Because the mortgage broker was making money on it. The bank officers had pressure to do these loans. And so now you got this $100,000 in your checkbook, and people start going crazy, buying motorcycles, buying boats, and then the market goes down. Hey, Jeffrey, how you doing? So that's the danger of having these credit lines that the banks are willing to give you just because you have the equity. Don't have that temptation there. Don't have that marshmallow sitting there in terms of money in the bank that you can just write a check when you see that thing that you really want. So again, be smart when it comes to taking out a home equity line of credit. Have a plan on how you're going to pay it back. Make sure it's really something you need versus something you want. And realize that if you are making improvements to the home, it doesn't work out to a dollar for dollar increase in the value of the home. So you need to take a lot of things into consideration as far as how long you're staying in the home and the costs related to the loan. And we can go into detail over this, but think about it. Do the math. Meet with your financial advisor. Meet with your accountant. Figure out, does this make sense? And most importantly, don't take out the loan if you can come up with a budget and a plan to save that money and just pay the things off as the contractors complete things. So again, thank you for joining me today. If you have any questions we didn't get to or you didn't want to put on here, just shoot me an email, mark@markmartella.com, and I'll be happy to answer your questions. If you have a topic you'd like to talk to me about, or like to see me talk about on the show, shoot me an email with your ideas. I'll be happy to do it. Hey, Todd, thanks for your kind words. There's the free resources on the Money Matters website. Again, the Money Matters website is just markmartella.com. Go to the free resources page, and again, go to our 2-minute tips. All the past shows here and all other videos are on there as well. So again, thanks for joining me, and remember, until next time, you have the power to choose to live a debt-free, stress-free life. Have a great week.